2025 saw broad-based gains across asset classes, with international equities leading the way. Emerging market stocks delivered the strongest performance, rising nearly 35%, while developed international equities also outperformed the S&P 500, gaining more than 30%. This marks the first time in over a decade that developed international markets have outpaced U.S. large-cap stocks. U.S. equities also posted strong returns. The Nasdaq rose more than 20%, and the S&P 500 finished the year up nearly 20%. Small-cap stocks underperformed relative to large-cap peers. Smaller companies tend to rely more heavily on borrowing to fund growth. And while the Federal Reserve did cut rates several times during the year, the pace of rate cuts fell short of expectations coming into 2025. Fixed income markets posted positive returns as well, with both bond indices finishing the year higher. The S&P 500 is becoming increasingly top-heavy. Today, the 10 largest companies control 40% of the index, a massive jump from the 27% share they held during the dot-com era. This creates concentration risk. The broader market is now heavily dependent on a handful of players. If these giants stumble, they could pull the entire index down with them, even if the rest of the market stays resilient. This chart tracks the evolution of inflation since January 2018, revealing a shifting landscape of price drivers. The pandemic era began with a surge in core goods as consumers pivoted to online shopping, followed by an energy shock triggered by Russia's invasion of Ukraine. As the world reopened, revenge spending shifted the pressure to services like travel and dining. Meanwhile, a combination of remote work and record low mortgage rates ignited a housing boom that pushed shelter costs to new heights. While we've seen dramatic progress with CPI cooling from a 9% peak in 2022 to roughly 2.7% today, the final stretch to the Fed's 2% target remains the primary challenge. Since 1989, U.S. consumer spending has become increasingly concentrated, with the top 10% of earners now responsible for nearly half of all expenditures. This shift, up from 35% in the 1990s, underscores the economy's growing sensitivity to the wealth effect. Because high-income spending is closely tied to equity and real estate performance, any significant market volatility now poses a direct threat to GDP growth. This chart illustrates the CapEx supercycle driving the AI build-out. Since 2024, spending by the top 5 hyperscalers has accelerated toward a projected $1.5 trillion total through 2027. This investment has become a primary engine of domestic growth, with AI-related manufacturing and data centers now accounting for roughly 1% of U.S. GDP. The trade-off is visible in the blue dotted line. Capital intensity has doubled, leaving a much narrower margin for free cash flow. As these companies race toward artificial general intelligence, the financial wall of maintaining the levels of investment is becoming a key investor focus for 2026. The blue bars represent monthly changes in non-farm payrolls. Since the second half of 2025, the labor market has slowed meaningfully, with some months showing outright job losses and others posting modest gains relative to the robust hiring seen in 2021 and 2022. Part of this slowdown reflects a normalization after significant overhiring during the pandemic, particularly in the technology sector. Another contributing factor is reduced immigration following changes in immigration policy, which has lowered labor force growth. As a result, the 3-month average job gains shown by the gold bar have declined substantially. The Fed's dual mandate is currently facing its toughest test of the decade. In 2026, the focus has shifted from how high rates will go to how fast they will fall. Currently sitting at 3.5 to 3.75%, the federal funds rate is at a crossroads. While the cooling labor market supports further easing, potential inflation wildcards, like new trade tariffs or fiscal expansion, threaten to limit the Fed's flexibility. This is a critical development for the technology sector. AI growth stocks thrive on lower rates, and any higher for longer surprise could tighten the screws on valuations. Given these dynamics, we continue to emphasize a disciplined diversification approach. Portfolios are constructed with exposure across all sectors of the S&P 500, complemented by non-correlated assets and, where appropriate, fixed income allocations designed to reduce overall volatility while maintaining long-term growth potential.